Okay, yeah, about 8 a.m., 9 a.m. I sent this out. And the reason why I did was because I wanted to update. Last year, I had the notes from last year, and I updated it for the latest budget figures that are available, or somewhat latest. That was bubble budget figures. So I got that and updated so I wanted to update that before the class, so that's why I didn't send it out until this morning. So you have that, and we're going to be going over some updated figures. We talked, I'm going to have to take that off. It's not social goods and income distribution. We're going to talk about government expenditure. And if there's any time, we'll start a little bit talking about the labor market, but we'll probably spend the lecture today talking about the government spending. It's a very interesting topic because, as we'll see, especially in this country, Japan the government's been spending an awful lot of money for the last almost 25 years now. Since I've been here. Since I've been here, the government has been spending a lot more money than it's been raising in taxes. And so we're going to talk about the government finance. This was a country that 25 years ago was in a very good financial situation, and now is one of the world's worst financial situations of any developed country. I think Greece might be worse, but obviously Greece is Greece, and Japan is a different. So the situation is different, and we'll see. It's a very different situation, but it's certainly of concern. The government has concern about it. The Ministry of Finance has wanted to get the government debt in balance, and it's just not quite working out. So we'll be talking about that, and we'll try to get a sense, well, how much of a problem is that? I was having I had a meeting with someone in the industry that I've worked in, the real estate industry, yesterday. We were talking about the government budget situation, and as it relates to bond prices. And he's in the I've done a lot of work in the real estate industry. He's still doing a lot of work in the real estate industry. And one of the problems is that if you invest Japanese real estate, the yields, what you get, the percentage return you get from investing in Japanese real estate is very low. And typically if you invest in Japanese real estate now, you're going to get, if you buy office buildings in central Tokyo, you're talking about a 3 to 3.5% yield. So on your investment, you're getting something like that. But now you can borrow at very low interest rates. You can borrow at interest rates that say like 50 basis points. You can borrow at very low interest rates, so you can get somewhat of a return. But the concern is if interest rates rise, and they could, these yields are going to have to rise, which means the value of the buildings, the price of the buildings are going to fall. Japan is looking very risky in terms of real estate investment for that reason. And so this is related to the government debt. If interest rates are forced up, and we're going to see there's certainly going to be upward pressure. That's one of the things we'll be talking about today. And that is the connection between government expenditure, tax and all that, and the investment market. There is a connection. So I'm going to introduce this by talking a government in an advanced country like Japan taxes citizens and spends money with a variety of social objectives in mind. Right? National defense, food security. That's certainly important in a country like Japan because most of the food, the majority of food is imported. So you have to have, that's a concern, food security. Educated citizen, it's always important. Access to health care, financial security of the aged, constructing infrastructure, promoting research and development. All these are very standard things that are done in this country. These are very standard things that governments in advanced countries around the world work, and in this section we will study the taxes the government levies and the bonds it issues to raise revenue and how this revenue is spent. And we'll focus on the government's current heavy debt load and how this current overhang of debt was accumulated, steps the government is taking and intends to take to deal with the debt load, and continuing to provide social goods society needs in order to prosper. So it's a big issue. These are really, we're going to be talking about things that are really central to our lives as people living in this society, that the government continue to be able to provide health care at the same price, or will that have to go up for the aged? Myself, I'm nearing retirement. Is the government going to be able to? I've earned a national pension. Are they going to be able to afford to pay? Will I actually get my pension? It's not going to be a lot, but you know, hopefully I can get it. But am I going to get that? Is it going to be? Are they going to be able to continue to provide build roads? Are they going to these kind of essential services? So these are some very important issues and questions that we have, and this is what as I say, I was working. The reason why I didn't send this out to you, I was working on updating these numbers, and this is the national government budget. The thing, and this is up through and including fiscal year 2017. That's the initial budget. The fiscal year runs through March of next year. So this is the current fiscal year. These are the figures that I used that was released in December of last year. So this was preliminary, the projection for fiscal year 2016, the budget for 2017, and these were apparently the actual result. I think it was the actual result, but I'm not 100% sure. I'm going to check on this for fiscal year 2015. But these give a good picture of the government, the big picture of the government finances, and what it means. Primary expenditures, these are the expenditures, 72.9 rising to 73.9 trillion yen. It's a lot of money. That's about 12-13% of GDP. But notice how tax revenues are lower, 54, 57, 57, 87. There's a gap. The gap in tax revenues. Now what we'll see are tax revenues have increased in the last 3 years, and in part because of the increase in the consumption tax to 8%. And I think there's no question it's going to go up to 10%. There's just no, politically it's not easy, but it really, it's going to be necessary. It's simply a shrinking labor force. The labor force is shrinking, more people age it, so they're leaving the labor force. Income tax is going to raise less money. You have to increase the consumption tax in order to get more revenue. And there's still a huge gap. It's a big gap between revenues and expenditures. Government bond issue, look at the percentage of that. That's a big percentage of bond issues. The bond dependency rate is over 35%. 35% plus of the government's funding is coming from borrowing. The government is borrowing more than 1/3 of every yen that it spends, every 100 yen that the government spends, it's borrowing 33 yen, more than 33 yen in order to make that payment. So that's borrowing, it has to be paid back. Somebody's borrowing and it has to be paid back. This primary balance refers to the difference between primary expenditures and tax revenues and ignoring government bond issues. So that would be if there was no government debt wasn't involved, and payments to service the debt, what would the primary, what would be what's left over? This is what the government would like this to be zero. Government would like this figure to be zero. Because if this figure is zero, then the debt is not increasing. If the figure is negative, then that means the debt is continuing to increase. And not only you're not paying down the debt, it's growing bigger and bigger and bigger. And you're talking about with low interest rates, if actually when interest rates go up, that's going to be a huge, huge problem. So this is a potentially gigantic problem, and we'll talk more about that later. Did I? Oh, I think that's the same. Yeah, okay, we'll just move on. This is the, now it's a little bit of, I think I put, oh yes, this is fiscal year 2016 and 2017. It should, this for 2016 and 2017, the forecast. That's the projection, the initial budget. We can see there's tax revenues, there's other revenues, a big part government bond issues, there's some construction bonds. This is the total amount of deficit financing. Some of it is raised by construction bonds. That some expenditure is raised from that. That's directly for infrastructure. Probably some of that now is still related to the Tohoku, the redevelopment of Tohoku region after the great Tohoku earthquake in 2011. Then the expenses is the debt service. You can see it's about a quarter, almost 25% of total government expenditure is just servicing debt. It's a major expenditure. That's about 24, almost 25%. That means the government is spending that to pay off old debt and to pay interest on existing debt and to retire maturing debt. So when debt return, that as a bond matures, that means it has to, the issuer of the bond has to repay it. So the government has to repay that. So a lot of expenditure goes to that. And you can see Social Security payments to the agent. That is, again, that's about 1/3 of the budget. We're going to see that's a dramatic increase. Local allocation grants are payments to local governments. The central government controls a lot of payment to local governments in this country. Local governments get a lot of their money from that. That's probably an important thing. Historically, when the local governments have had more control, there's been a little bit more corruption. That was kind of, so that's kind of been an issue of the central government in order to kind of monitor the local governments. So it's an issue of control and a little bit of historical, to keep the level of corruption low. Then we're talking here. This shows the fiscal year 2017 budget expense details, and we have the National Debt Service. As I say, it is 23.5 trillion yen. That's 5% of GDP. So almost 5% of GDP is spent on servicing the national debt. We're going to say it's a big number. Now, what's interesting here, the bond maturity is 14.4 trillion. Interest payments are 9.1 trillion. You're talking about, those are interest payments. That's about, do you know what that is based on the debt? That's interest payments. That you look at the size of the debt, that's about an average, the average interest payment is about 1.2%. That's the payment. That is that the government has borrowed money at an interest rate of about 1.2%. That's the average, roughly. So 9.1 trillion, and it's about 850 trillion yen of total national government debt. We'll see the exact figure a little bit later, I think. But so that's just a little bit over 1%, 1.1, 1.2%. Well, what happens if the interest rates go up to 4%, 2%, 2%? Forget 5%. Now, I assure you that one of the things that can happen overnight, is we can wake up. We can wake up and see that you might find out interest rates could suddenly rise. The world can change. Interest rates, the world can change very quickly. And I was explaining, I'm trying to remember did I explain to this class that before the mid-1990s, that the lowest historical, in financial history, the lowest historical interest rate of sovereign debt was about 1.6%. That was the historical, before about 1995. The all-time global ever record, the lowest interest rate that was ever paid on sovereign bonds was 1.6% before 1995.
All over the world.
In financial history. In the history of finance. Ever.
Government bond.
Government bond. The lowest interest rate that a government ever had to pay, that ever paid on a sovereign, on the market traded bond. That was the market rate. The market rate, the lowest ever was 1.6%.
Wow.
What country? Does anybody have a guess of what country that is?
Can you give any hint? Which year?
Japan.
No, before 1995. Before Japan. What year? What year? You want to see what year?
Yeah.
I think about that.
Italy.
Yep.
Genoa.
Genoa.
That's how.
Yeah, Venice probably was close.
It has not been Italy, but.
Right. Yeah. You're right. The good thing. Right. 1600 would have been Italy. Exactly. Because as you know, as you probably know, the sovereign debt market. There was a very robust sovereign debt market in the Italian city-states in the 17th century. A very liquid, very actively traded secondary bond markets in Venice and Genoa, and I think for Florence as well. So, but that was the all-time. You're talking. The world has never seen what's going on now. In financial history, this has never happened before. These kind of interest rates. This is crazy. This is way low. And look at the payments. It's 10% of the budget on incredibly low interest on historically record low interest rates. These are not going to stay that way forever. And so when that day comes, it's going to be a very dramatic situation. And I think Japan won't be able to, because of this, the way that of the aging of the society, Japan will not be able to insulate itself, I don't believe, from the global debt market going forward. And I'll explain more about that later. But anyway, that's a big potential problem. We can see that this 19.9 figure includes all three of these. The data I was looking at today, I can dig that up. I just couldn't, in the time that I had to prepare this, I couldn't find the specific figures, but that 19.9 trillion yen is for all three of those items: education and science, national defense, and other expenditures. Let's see, this is the, that was for 20, I think I did that for 2015. Yeah, that was the budget, just to compare that. That was the revenues. I haven't been able to update this yet. I'm trying to find this information. The income tax was 16.4. Consumption tax was more. That has gone up. That figure has risen. And the reason is that income tax, you can only, the income levels have fallen, so the ability to tax income has gotten weaker. Corporate tax rates are affected by, Japan has to compete with other countries to attract corporate activity, and then there's other taxes. Consumption taxes are now the biggest part of tax revenue. As we say, this was for 2015 deficit financing. This was a subset of construction bonds. That's the other revenues, and deficit financing then was 30 trillion. Yen. So here's the current, this is the expected current debt situation in 27. This was, as I say, this was in December 2016, released by the Ministry of Finance. So the Ministry of Finance released these figures in December of 2016. I think I can try to look for the actual figures here, but it's going to be close. These should be close. The outstanding government bonds, as I say, 865. So you can see 9 trillion, 860, just a little over 1%. That's that 1% that they're paying on the debt. So you just do the math there. 9 trillion, if you're paying 9 trillion in interest, and there's 865 trillion, that's a little, just over 1%. The interesting thing, you can see the national, this is the outstanding government bonds of the national government. See how that figure is steadily rising? Just keeps on going up. Just going up, up, up. That is that figure has just ballooned, it's just continued to balloon. It's just, they're trying to get it under, might be a little bit of a wish, although economic growth is increasing. So your economic growth is increasing, that means that spending increases, then the consumption tax, that's going to have a positive impact on the consumption tax. So you're probably going to see now, if the economy continues to grow, then you're going to see an increase in consumption tax of 10%. That's probably going to be coming in the next year or two. And then, because they really need to get this debt under control, you can see this outstanding government, that's national debt growing. Look at the local debt. It's not growing. The national government is saying to local governments, you cannot borrow any more money. You're going to have to make do. You are going to have to make do with what you got. They're increasing a little bit what they're providing to the local governments, so they're able to increase it. That's part of the government. And think about it. In order for the national government to control the local governments, they have to be able to give them money. And if they can't, then you start getting some rebellion by some of these local governments if they can't provide the services that they need to their local people. So there's always a little bit of a power play here. That's the political science. A little power aspect of that is that they're telling the local governments they can't increase their debt. So local governments aren't increasing their debt. That's staying very stable. This figure, this is the latest. It's actually below 200% because the GDP has risen. So as a percentage of GDP, if you compare that with a year ago, the debt situation's looking a little bit better. It's not as severe as a percentage of GDP, but that's almost 1.1 quadrillion yen. If you didn't know that there was something called quadrillion, that's 1,000 trillion, or a billion. It's lots and lots of zeros. That's 1 and 12 zeros. That's a lot of money. 1 quadrillion yen, and almost 1.1 now. Quadrillion yen of total debt, and 80% of that is national government debt. Big, huge. As I say, Greece is the only country of the advanced industrial economies that has anything that compares with that. So where did this debt come from? And I think this is important to talk about that. And when I came to this country, I came to this country in 1992, and it was a very different situation back then. Very, very, very different situation. So what we'll want to do is see how this has evolved over time. And this chart shows the expenditures and tax revenues over the past 28 years. And it's really the story about the building, the story about what Japan has struggled with, and how the debt has grown over the last 28 years. When I came to this country in 1992, the country was entering its first post-bubble recession. I arrived here in June of 1992. People thought, I got here, people thought everything was kind of okay. They were just having a short-term slowdown. And I remember they were they were writing about how there was going to be an inventory. All it had to do was an inventory adjustment. There's going to be an inventory adjustment, and then they were going to get back to 4% growth, because Japan had 4%, 5%, 7% 8-9% growth. That's what Japan had experienced since the late 1940s. So the late 1940s, 45 years of that kind of economic growth, people thought that what they had in the late 1980s was just going to go on forever. And I remember that there were people, that foreign analysts were coming into this country and taking a look and saying, the party is over. They were saying the party, in 1992, they were saying the party was over and that this was going to be, there was going to be major structural changes. That what had happened, the bubble was a disaster, had been a disaster for the economy, that it was going to cause tremendous changes. People saw this, at least foreign observers, but a lot of people here didn't see it. They didn't see it. They were kind of living in, and really even well into the 1990s, they were living in a world that they thought that was just going to come back. That prosperity was and economic growth rate was just going to come back naturally. And so because of that, because there was that belief, and there was a belief that they didn't really have to change to do much change, they thought, well, we can ride this out. The government thought we can ride this situation out. So what happened was here in 1993, you started getting, of course in 1993, the stock market's collapsing. Stock market is absolutely, from highs of about 40,000, the Nikkei had reached like 39, I think it was 39,000 was the peak. 39,000, it was like 14,000.
Wow.
It was one of the great, and what was interesting was that and I remember hearing people were coming. I would go to meetings of business people, and traders would talk about, they would get calls. Foreign traders were talking about getting calls from the Ministry of Finance saying to stop, selling. They were just, you're manipulating the market. Stop selling. They were saying about getting phone calls. The government thought they could, that this wasn't real. What was happening? They really thought that. So that was part of the mentality. And so you had the stimulus packages that started coming. That started coming in around 93, 94. You started seeing stimulus packages. So you see here it's fairly flat. Then, as a result of this first recession, post-bubble recession, you started seeing these stimulus packages. And notice how revenues dropped. Revenues fell by more than 10% between 1991 and 1994. Here's the peak of the bubble. Right here, the peak in terms of a lot of things, especially the real estate market, peaked in 91. Economic growth was still positive in 91. It started to turn kind of negative in 92. So you're starting getting these changes. And they're thinking, okay, we'll just have construction. And a lot of it was construction bonds. There was a lot of the stimulus, the traditional stimulus in this country had been construction bonds. And we'll see that a little bit later, how the dominant, that borrowing at this time, borrowing was dominated by construction bonds, not by Japanese government bonds. So it was construction bonds to fuel infrastructure development. So they thought, okay, we're going to run out. We'll just build a bunch of roads, and roads. Well, they might not be going anywhere, but we'll send people out to build these roads, and that's going to keep the economy going. So that was the thought, and you can see these expenditures kept on going up. 94, 95, 96, 96. Now you get 97 is when you got. 97 was the consumption tax. So in fact, in 1996, people thought that a lot of people thought the economy was recovering. The economy grew by more than 3% in 1996. People thought, okay, the real estate market, land market bottomed out. And everybody started to think, okay, well, the bad times are over. Now think about it, that was 20 years ago. People thought the bad times were over. I think where we are today. 20 years ago, they thought, they don't think, people are, that was still fresh enough that in 1996 people would think that the problems would be over. Even people like myself thought, it might be over, but we're still seeing a lot of problems. People like myself, people that foreign analysts that were looking at situations saying, I don't know, maybe, but I don't know. So at that point, the consumption tax went up from 3 to 5% in April of 1997. And because the government thought, okay, we're past this problem now. We're past this problem. We can raise, we can increase the consumption tax because we've got this low revenue. We've got this gap. We've had this gap that built up because we've had the stimulus. We've got to increase revenue. Well, it didn't work out very well at all. It only went from 3 to 5. It was 3 to 5%, 3% to 5%. It went very badly. Now, at the same time, you had the Asian financial crisis, and as some of you might know, because of the other class that I teach, the Asian financial crisis was to a significant degree a crisis of the Japanese banks. That the Japanese banks had overlent, they lent too much money to businesses and governments in countries like Thailand, especially Thailand, Indonesia, to a lesser extent Malaysia, and the Philippines. But a lot of money got lent, and it was money that was not properly, it was unhedged. So that the currency exposure was unhedged. These countries' currencies collapsed, and basically it made the Japanese financial system, it was insolvent. The Japanese financial system became insolvent in 1997. So now you really had a crisis. You really had what was going on then was just wow. You know, and it was exciting as an economist to see all this stuff happen. I was just like, boy, this is like, it was pretty dramatic stuff. I mean, so it was kind of both being in the real estate market, being an economist, and I would be, writing up articles and, about the real estate market and about the government policy and all, and, giving speeches and stuff. So it was kind of an exciting, it was exciting to be a foreigner, to be in the middle of the real estate, all of this stuff that was going on. So that's what I was doing back then. But so I was looking at people, myself and other foreign analysts were looking at this and saying, oh boy, now it's really going to go bad. So a second recession. So that was the second post-bubble recession, and it was even worse than the first post-bubble recession. Now the thing was that in 1997, at the beginning of 1997, a lot of people here thought that, as I say, the problems were over, that we were past this, and now Japan had done a few structural changes, but nothing really big, and now we can just go on and we'll live happily ever after. After 1997, and basically the insolvency of the financial system, finally everybody realized that things had to change big. And I'll tell you one of the things that I don't know if I mentioned this in this class. But one of the things when people started coming over and they were looking at the finances that went into the banks defined, well, what's the debt? Because foreigners were going in to try to advise on this, and they were going into the banks, and the banks didn't know how much they could lend. They had no idea. They had absolutely no idea. They went in, the records, this is 1997, the records were all on index, just paper and index cards. It was just in files, all the loans, it was all written out. Nobody had analyzed any of it, because nobody thought it would ever go bad. That was just, they just kept the record. It was just on an index cards in a file, and nobody had ever figured out how large it was, because they either figured A, they were going to get paid back, or if they didn't, the government was going to bail them out anyway. So there's somebody going to get bailed out, or that was what was called the convoy system. It was what we call the convoy system. That everybody was going to be in a convoy, and somebody broke down, then everybody else would get the convoy was going to take care of anybody with a problem. So that that was one of the big one of the big changes, and that in order to clean up the debt of the banking system, your corporate debt was out of control. Corporations, a lot of corporations were technically were insolvent. Some of them did go insolvent in that era. You had, I think 97, 98 was the Sogo. I don't know if you've ever heard of it. Do you know the Biku Kamada in Yuracho? Do you know that store? Do you know the Sogo department store chain? Exactly, you don't, and there's a good reason. It disappeared, basically disappeared, and for good reason. Sogo department was one of the major retailers in this country. And in 1998, the government announced, and this is when things really started to change in this country. The government announced they did a deal with Sogo, because they had a lot of stores internationally. They had stores in London, they had stores in Hong Kong, I think New York. They were like an international, known department store. And they announced a 30-year debt restructuring plan that the government was going to lend Sogo money, and to have them take 30 years to recover. And basically the public erupted in anger. There was such a negative public reaction. They basically said, "Are you kidding that you're going to support this kind of?" See, this is the kind of stuff. 1998, they wanted to spend this like trillions of yen to prop up dead badly run companies like Sogo. Then things started changing, but you can see 1998, we got this recession now. 1998, look at and the bottom was 1999, right there. 1999, look at that, 47.2, you're down now 25% reduction in revenue, and a 30% increase in expenditures. 25% reduction in revenue, 30% increase in expenditures. The numbers weren't added. Look at the gap there. Now you're getting huge. Now it's basically just barely 50% of expenditures are being covered by revenue. So and the government is spending all this money. They're trying to keep the economy going. The economy is shrinking. It was a very, very difficult time. So as a result, now this was also the time of the dot-com bubble in the U.S., but Japan was in a deep recession. So Japan was going the other way at that time. Japan really looked like a sick. It was like a sick country. That was when a lot of stuff started changing. 1999, the bottom of that, the real estate market started changing. There were starting to see changes and reform, changes in the real estate market here, that some dramatic changes that started happening. So that was, personally, it was a very exciting time because I was involved. I got involved with a lot of that. That was an important part of my career, and would be for the next 10 years from that time. So for myself, it was an exciting time, but really it was really a tough time from public expenditures. And you can see again, there's kind of another recession, another kind of mini recession here. Not as bad, but 43.3. 43.3. There was. It wasn't. It did. The government did increase the expenditures because it's just seeing there's so much debt. The debt is the gap is so large. There's just the expenditures are just falling. There's a lot of pressure to avoid spending more money, and then you got that recovery in the mid-2000s. This was that global expansion that was a debt-fueled expansion as a result of the Federal Reserve, especially the Federal Reserve, that was propping up the American economy and putting a lot of liquidity in world markets. And there's a lot of liquidity out there. As we saw, as a result of the collapse of the dot-com bubble in the United States, we saw that, and so we saw what was essentially an artificial economic growth in the United States in that time. And so Japan was kind of tagging along, so you see an increase in expenditures, in revenue here during this era up to 2007, and fairly steady, somewhat lower, so you're beginning again to see, they were starting to think, okay, maybe now it's the hard times are over. You know, maybe finally now it's the hard times are over. And what's interesting, well, the hard times hadn't really even hit. That was the fascinating thing, was the hard times had not even hit. So now 2007, of course, we know we have the global financial crisis beginning in 2008. Japan now gets hit. 2009, Japanese economy shrunk by 9%. So you had massive, massive shrinkage of a depression kind of situation in 2009. Revenues jump just because you've got just a crisis, absolute crisis. So revenues jump. Expenditures jump. Revenues fall to 38.7, the lowest. It's more than a third lower than in the revenue collection, third lower than 17 years earlier. A third lower, 38.7. Just and look at the gap. That's more than 50% of 60% of the government expenditure is debt. So the government debt begins to explode. Absolutely started exploding. So all this time, you're seeing they keep on thinking, okay, maybe we're getting to the end of the crisis, then boom. Then it kind of like, okay, maybe it's getting better, boom again. You know, so you have these kinds of explosions in debt, and basically, and it's one of those things that the government's kind of, as we say, kick the can down the road. They're kind of kick the problem in the future, and hoping that the problem goes away, and not making a lot of changes, because that can cause problems, and that's understandable. But later on, it doesn't work out, and so that's the situation now. So since 2009, we can see the picture and the story is a slow, steady recovery. Then we had here, that's the increase in the consumption tax. But look what happened was that expenditures never really fell. Expenditures reached a new level, and the reason is that now by this point, then the society is aging. And we'll talk about that in more detail, the effect of the aging society on the labor force. But you can see because of that, then the need to spend money on promises that were made to retirees. Government has to do that. That's growing, and the unfortunate thing was that at the same time, and it worked out that the same time that the government expenditures, in order to fulfill the government's promises, I've stayed on this so long that it thought that. I have to keep on doing that. But the government's promises, it had to fulfill its promises to its senior citizens. So expenditures now are at a new level. Now from 2009, now you've got, so at the worst possible time, that bulb started hitting. So it's like all everything, the bad, like the worst things that you could imagine. This is like a worst case scenario. If anybody would have predicted this in 1991, they would have said, you've got to be kidding. If anybody predicted that that's what would happen over the next 26 years, you would have been. This is even worse than anything I could have ever imagined in 1993, 1994, personally. I looked at it, I thought it was going to be bad, but I would never have said that was worse than I would have ever imagined. Because I was doing work, even in this period, I was doing valuation work. A lot of work at that time that we were. I was working for working as a consultant with a developer consortium, a developer investment consortium that were buying up logistics properties, and I was doing the valuation of the buildings, and we're going all over the country, doing that. So they were, and my evaluations were assuming return of that inflation was going to return at some point. Not big, but a modest. I was projecting my model's 1.4% inflation rate, which was kind of what the government was trying to do that. They just could never. Yeah, well, I'm saying that even that was I thought it was modest. It turned out my valuations were okay anyway, but that's another story. But but so going up to the financial crisis, there was just still a feeling that everybody had a feeling like somehow it wasn't going to be that bad. But it turned out, as it turned out, from in terms of the finance, government finance, this was an absolute disaster. So the debt now is bigger than it had ever been. So now, after the financial crisis, now you've had all this crisis for 20 years. The problem was the government kept on thinking that the problem was just about over. And they were spending money, they were making commitments and spending money as if the problem was just about over. And every time that they thought the problem was over, then the problem got even bigger. And that's the story, and that's the big problem here, is you had this downturn, the global financial downturn, and now the government finances are absolutely out of control. The debt now, 60 trillion, over 50 trillion, nearly 60 trillion, 50 trillion, 50 trillion, year after year, 50 trillion, that's 10% of GDP. Those are debts that every year, 10% of GDP, the debt was increasing. That's huge increases. That's absolutely huge increases. It's incredible increases. This is really, government, that's unsustainable. Absolutely unsustainable. So you had here was that consumption tax rise from 5 to 8%, and you saw the improvement in revenues, and we've seen a slow increase, and this might even turn out to be great. It was 57.7. But what's interesting is you look at this, we are 27 years later. It's still less. It's still, revenue, government revenue is still less than it was in 1990. Like, wow, 27 years. And you people have grown up, those of you that grew up in this country, you think that it's normal that there's zero inflation. You think that's normal. It's not normal. This is not a normal situation. You've grown up, the prices stayed the same. It's not normal. It is not normal. This is not normal. You know, see this kind of you'll never see this again. I'll tell you this, and you'll go back and in your careers as you get older, you'll go back and okay, this is the way it was. It's not going to be that way. The normal is some level of inflation. You know, some level of growth. And when those interest rates go up, then there's going to be, you can see, this is where this debt, as I say, right in here now is where you just, now the debt is exploding. So even now, we still have 40 trillion yen debt. We're about the same as we were here, 40 trillion annually. It's still huge. The problem is still there, and you can see that even an increase to 10%, it's not going to solve the problem. It's still, the increase of the consumption tax to 10%, you're still going to have, it's still a huge gap. It's a huge, you're going to have a lot of economic growth. I would basically say this Abenomics hasn't really, I don't know if it would ever work. And unless, I think, what else could they have done? I don't think they could have done any. So here's the bond dependency ratio. Where did the debt come from? The bond dependency ratio shows we're looking at how the GDP, one of the things you can see, this is the GDP's right axis. It's hard, you can't put, I suppose what I should do is put lines, the 0% line of GDP is right here. The bond dependency ratio is here. You can see, here's the 1970s. Now, the 1970s was actually the era of high inflation. You had like 10%, you were having 10% inflation in this country, 10, 12% inflation in this country in the 1970s. So, but it was also, look at the growth rate. $8 to 12% growth rate. You're at a very, very rapid growth rate. It's slowing down. It's slowing down because of the energy crisis, the first and second energy, 74 and then later, I think 78, 79, second energy crisis. Growth is slowing, but it's still, this was the kind of growth rate that people were used to. And so here we go, 1986, here's the bubble, here's the asset bubble here. People thought this was just normal. That's what they thought. As I said, in 1990, 1992, when I came here, people thought that this was a normal growth rate. So it'd be interesting to see, you know, and I think China is going to be, in the future, what's China going to be dealing with when, you know, the growth rate is not 6, 7%. It's not 10%, it's never going to be that anymore. When it's 3, 4%, you know, it's going to be, there'll be some interesting things are going to be happening. But that's what this country's been through that. So, you know, there's, I would say for China, they have to prepare, you know, for that. That's going to come. But here you had, here's what's happened. I said the asset bubble burst, you go into recession. You can see here, it's like 2%. Look at that, it's never, since then, it's never been above 2% really. It's never really been above 2%. Below zero. Here it's, this is the, and I think that some of it might actually even be lower than this. But the thing is that you had a bond dependency rate. This is okay. See how high the bond dependency ratio here? It's 30%. The government's borrowing a lot of money, but the economy's growing. It's okay. That was fun. With that kind of growth rate, you can borrow. You can borrow a lot of money. So they could borrow money at so 30%. But if you got a 10% growth rate, you can pay that back. It's no problem. It's just part of a rapidly developing economy. You need lots more infrastructure. You need all that. That's a normal thing to do. It's very normal. So actually, you can see in the bubble, the bond dependency ratio fell, and they thought, okay, now we don't even need, you know, this is like, what a wonderful economy. Economy's growing. We don't, you know, it's developed now. We've got a lot of infrastructure. We don't need to spend a lot of money. We don't need a lot of bonds. Boy, this is going to be wonderful. You know, life is going to be like this forever, except that it didn't work out that way. And so you can see now, here is the response. But you can see it here. You see how the bond ratio is growing, but it didn't really grow very much. Now the reason that this percentage looks relatively low is because much of the debt in this era was construction bonds. It was not these are government bonds, these JGBs. These are JGBs. It increased, but not a lot. A lot of the stimulus was construction bonds. So that's why this percentage stayed low. But then you had the Asian financial crisis, and one of the things that happened was the construction companies. You couldn't prop up the construction companies anymore. The government now is in massive debt. Propping up the construction companies ended. So that party for the construction companies ended. Now it's just the government is financing by debt. It's all debt. Now it's 35-40, hits the peak here, nearly 50% here 2009, but it's staying like near 40%. Even now, and you see the financial crisis. Again, you had another spike, but we're still, you know, from the Asian financial crisis, we haven't really been much below 40%. So that's 20 years. That's 20 years now. That's true, but this is still, I haven't updated it, but it's going to look quite similar. These are just going to project. This is one of the ones I haven't been able yet to update. But this is your 20 years of bond dependency ratio, 40%. You're issuing bonds that cover roughly an average 40% of national government expenditures. That's, you know, when that bill comes due, that's going to be a real problem. And that's what you have to worry about. We really have to worry about. Now, I've been talking about the construction versus debt, bonds versus deficit financing bond. And it really tells the story. This chart tells the story about how the government operated. I mean, the government was almost like a branch of the construction industry in the 1980s. I mean, the reason was that, you know, the infrastructure, there was a lot of infrastructure needed. You know, you had to build all this concrete stuff. And you go to a beach here, there's all the concrete stuff. You know, you had to pour a lot of concrete. You know, and the line concrete in all the rivers and all that stuff. That's what all that money. You know, they were keeping the construction companies. The construction industry was about 10% of GDP in the early 1990s. So it was very, very high percentage. 10%, construction, 10% of GDP. That's something that happens in developing economies. Japan by that point was kind of past that, but people didn't realize that. So they were dependent upon that. The government revolved around the construction companies and Dango and all the illegal, you know, price fixing and all this stuff that was going on back then. As I say, so the borrowing, 1980, 1990, and then here's the stimulus packages. I talked about these stimulus packages. It was all construction bonds. This is accumulated government debt. So let's look, what you want to do is look at the accumulated, the government's going to pay some of this off, but you can look on the margin and get a sense of that. From here to here, 85 to 90, that went up 27, that went up 6, so 2/3, 3/4, 56 and 2, that's 1990, 1995. The total accumulated government debt and government bonds went up 56 trillion yen, debt financing went up 2 trillion. It was all government bonds. They were trying to prop up the economy by through construction, by throwing money at the construction companies. They were going to employ everybody, and then when the problem was over, then they would reduce that, and the construction companies would just do normal construction company work. But here in this now, after 1997, that shifted. And you'll notice here, this went up 51 trillion in construction bonds, 91 trillion. So one of the interesting things is that the accumulated debt to 1995 was 67 trillion yen. Now in 2000, I'll have to update this, but 2017, now you're talking over 600 trillion accumulated. Accumulated debt financing bonds over 600 trillion yen. 10 times in 1995. 10 times the accumulated debt. So you can see now the shift that occurred between 1995 and 1990, and then by here 36, 138, minus 1, 110. It's all now deficit financing. And basically it's a country that can't afford to have frivolous construction projects anymore. That's one of the things that really changed. 1995, the country could throw money at construction projects. By 2010, that was over. They couldn't do it anymore. If they're going to spend for construction projects, it had to be for something for real. And here, obviously, this is from the earthquake. So that's earthquake construction related. That's expenditure I'm sure the government would have rather not done, but they had to do. They had to do to rebuild. That area had to be rebuilt. But you'll notice since 1995, the debt financing bond issuance has outpaced construction bond issuance by a ratio of nearly 6. It's probably closer to 7 to 1 now. It's probably like 7 to 1. It's all debt financing. That means the Bank of Japan is issuing bonds. They're issuing bonds. So what's interesting, all that era, 1997, the last 20 years, has been very low interest rates. This, as I said, the average of 1.2%. That's pretty close. It's been somewhere. The government, we'll see shortly here. The government the payment on the debt started declining quite dramatically in the late 1990s. Here I'm going to show, I really like this, and I was able to the update. It's actually the same as, it turns out it's the same as 2015, but this shows, this is how the government priority, both you can see as a developing economy, what happens is an economy is developing, I'm just going to sit down here for a second, as the economy is developing, and you can see how that changes, but also the beginning as the government takes on debt, and you can see in 1965, other expenditures, that was, and not national defense was, that was for expenditures, it could be infrastructure. The government was spending, had a lot of money to spend on, and most of the government spending went for that. Only 14% was for Social Security in 1965. Now notice how the local government allocation hasn't changed that much as a percentage. It went up a little bit. In the good times, they were throwing a lot of money back to the local governments, but that pretty much has shrunk. It stayed steady, and then it's shrunk in the last 12 years. But notice how the other expenditures, a steady decline, 1965, 1979, 1985, and because debt service is growing, Social Security but primarily debt service. So the debt service, the government started borrowing money in the 1970s, 1980s. As you can see, even the reason we think about 1965, the country was still quite poor. Japan was still quite poor in 1965, and Japan wanted to do it without borrowing. The banks lent. They didn't want to. Savings were high, but it was recycled back to the banks, and the banks lent it, and so the actual government debt was quite low at that time. It's what they were able to do. But in the 1970s, now the government had to spend more money. Growth is slowing a little bit. They wanted, and they're seeing the opportunity to expand debt at the same time provide more services. The increase, Social Security is beginning to increase. 1995, now the big changes between 1995 and 2005. And not even the increase, it's not the debt service, it's now the Social Security. And you can see Social Security now, see it stayed fairly steady, 1975, 1985, 1995. All through that time, you look at the demographics, were fairly stable. Demographics were fairly stable. The birth rate was fairly high. There's still population growth. There wasn't a big increase in the retired numbers. Fairly balanced. With the recession, early 1990s, everything changed. People couldn't afford to have children anymore. They couldn't afford to have. People couldn't afford to have two children. And it's really with that crisis, the demographics. When you look at the demographics of this country. It was all fueled by the collapse of the bubble economy, the collapse of the post-war World War II recovery, the collapse of that in the 1990s. The society, people suddenly couldn't afford to have children, and so the birth rate dropped below replacement rates. The Social Security began, now you're starting to get an aging of the society. You had a slow increase anyway, but now it starts, between 1995 and 2005, it becomes important. Note the debt service doesn't change a lot, because even though the debt's rising, but even though there's an explosion of debt, the interest rate is so low that the debt servicing rate doesn't go up very much. But something has to give. Other expenditures down to 33%. That's expenditure on research and development, on national education, on national defense. That, of course, national defense is limited to 1% of GDP, but that's still a slice of. That's got to come out. All that's got to come out of that. I can assure you that national defense doesn't get cut. That doesn't get cut. So it's got to come out of out of research and development, that type of thing. But even the big change, even bigger change in 2005, 2017. As I said, we saw after 2009, the explosion of government debt. Absolute explosion of government debt, explosion of expenditure, and what did it get spent on? That's what they had to spend the money on, Social Security, 33%. That hasn't changed. Actually, this table, 2015 to 2017, it's still allocation's the same. But the problem is, in the local government allocation, they're able to less than 16%. You know, you got to keep those local governments. The national government can't afford, is running out of ability to finance the local governments. So that's going to be a big change. You know, I know, for example, I look in my, one of the things that I wonder what you're going to see. I look down, like, I'm from my building, I look down, there's a park below my my balcony, and they got old men in there cleaning all the time. Got these guys who are standing holding signs, you know, a lot of elderly people that are, you know, they've got these kinds of jobs. Some of them, you know, these guys that go in and they're sweeping every day. You know, I mean, there's, you know, they're cut, you know, I mean, there's like they're trimming the lawns and taking a blower and blowing leaves and, you know, making noise and blowing the leaves in different directions. You know, I mean, it's make work. People, and that's okay. I mean, there's nothing wrong with it. You know, it's giving older people something to do. You know, it's an important part of the society. People feel like they're part of the society. They're out instead of sitting at home and getting depressed. And, you know, I mean, the good thing of that is it keeps people active. You know, they stay healthy. You have the sports centers. You know, you can afford the sport. They're paying for the sports centers, so that keeps the healthcare expenditure. I mean, there's reasons to do that. I mean, it keeps people engaged. I'm not saying it's a bad thing, but you go look around, you look and you see, I mean, the reality is they're not really doing anything. They're finding things for these people to do. They're finding something for them to do. And they're keeping, so these people can feel they're a part of the society. But what happens when the government can't afford that anymore? That's what I'm wondering. What's going to happen when they have to cut that kind of stuff? They have to start cutting those. That's what they're going to have to cut, are all those kind of jobs where these people, you know, and where you got 6 people that are standing holding signs at a construction site that aren't doing any work, you know. And the thing is, I'm so used to, for me, it's natural to see all these people at a construction site that really aren't doing anything. You know, they're just standing holding a sign, or, you know, waving you around because the regulation says that you have to have that. And it's just keeping people employed and giving them something to do. You know, the government may not be able to afford that. I mean, the fortunate thing is that there's the labor market's getting tight, so maybe elderly people they're just going to stay in their jobs longer. That might be what's going to happen. Those are kind of some of the changes that are going to have to take place because there's no more money. Because what happens when this explodes? Interest rates double. Forget going to, I don't know what happens if it goes to 5%. If it doubles, that means that debt service has to go up to 50%. Or something like 50%. What happens? What on earth happens? You know, that's going to be a shock. That could be a shock because all this. Notice how the debt service, 1985. Remember what the size of the debt in 1985, and now 2017, 32 years later, and it's only 4% increase as a percentage as an increase of debt service. Only 4% increase, and it's just because with massive increase in debt, it's just not sustainable. It's really going to be a crisis. That's going to be a crisis when that happens. But the interesting thing is how are they going to deal with that? But this is how the realization, the interest rate. See, this is why they're able to do it. Because at the same time that the debt starts exploding, the interest rates drop. So that by interest rates at 6% in 1990, 1995, it's in the 4s. 2000, it's below 3. By 2005, it's at 1%. And now, as I say, the average is 1%. So all of the, you've had, since 2005, you've had that complete turnover of the older debt. And so now it's all the debt is financed at these lower interest. Remember I said it's an average of 1.2%? About 1.2%. Well, look, that's about 1.2%. And that's the interest rate. It's all of the debt is now financed at that low interest rate that's prevailed since 2005. So since 2005, the government's been able to borrow, and actually a little bit before that, it's been able to borrow at, and as I said, that was below the general bonds of the 17th century. You know, and so the government's been able to do that by borrowing money at this kind of interest rate. So one of the things that's very interesting, we want to know, well, what are the bond holdings? What are the, who holds these bonds? And I had this, and I updated this. I was able to update this last night. So this was instructive. So this is 2014, March of 2014, the end of the fiscal year, and you can see how the Bank of Japan bond, the BOJ, this is the 20%. So 20% of the bond holdings were held by the BOJ. So this is quantitative easing. This was 2014 quantitative easing. The government, the Bank of Japan buying government bonds in order to compress interest rates, long-term interest rates, to manipulate, to control the yield curve. So they are holding 20% of bonds. Now remember also that the interest rate is like 1%. So you're talking about a 1% interest rate. Public pension 7%, other government 2%. So about 29%. Government was holding 29%. Then the pension, the banks 37%. Can you imagine? Now think about it from the standpoint of the bank balance sheet. So if you're holding bonds, the government, basically the government was kind of saying, here, buy bonds. You know, you want to buy bonds, don't you? You know, they're basically forcing the banks to just fill their to fill their balance sheets with this government debt, and just they're gorging. I mean, they're basically overflowing with government. That's 37%. All that debt was held by the banks. Now think about what happens if you've got, and this was at yields of 1.1, 1.2% average yields. And imagine that a fair percentage of that is held as long-term, 30-year bonds. You got a 30-year bond. The banks have a lot of 30-year bonds, or even 10-year bonds for that matter. But let's say 30-year bonds. What happens? And as we've talked about, what happens as sudden interest rate increase? Well, their balance sheets get blown out because on their balance sheets, they're going to have to mark to market. If you mark to market on the balance sheets and you hold this much government debt, and the interest rates blow up, the interest rates increase, your balance sheets blow up. You're going to get a balance sheet blow up because you're marking that to market. Suddenly the value of that drops. There's a lot of banks would get into trouble. Will get into trouble because you're talking about 37%, 800 trillion yen. You do the math there. It's 300 trillion yen. That's 60% of GDP. The banks are holding 60% of GDP on their balance sheets. The Japanese banks, these domestic banks, 60% of a sum equivalent to 60% of GDP. That's pretty scary. That's scary. So 60% of GDP, and if it drops by 30%, that would be a reduction in value of like 20% of GDP. And just to throw out a number, you can run some numbers. That would be like 20% of GDP just poofing, just disappearing in terms of value. That would be a big problem. 19% is held by insurance companies, and these again, it's the same problem. The insurance companies have to pay out. It's kind of like pension fund, kind of private pension funds, this kind of stuff. So they're holding all this stuff. 56% is held by these private entities. There's a lot of people that are depending upon this value in terms of their retirement, all of this stuff. The healthy economy. This is dangerous to have this kind of debt. The pension funds, though, holding only 3%. The direct pension funds, households 2%. That's good. it's good, you don't have the households. Others, and foreign is 8%. Now the question there is that what is on the margin? What's the foreign holding on the margin? And in fact, the short term, I don't have this table here, but I looked at these figures. In terms of this, the short term government debt, a lot of that's held by foreigners. So the government foreigners are doing a lot of short-term borrowing, and it must be because they're figuring, since the government is going to prop up the bond market, they're just jumping in order to get, to get increases, not yield. It's not a yield play, but it's a yield compression. I think it's a yield compression play where they're actually getting the value of the bonds are going to go up because the government is supporting the bond market. So 8% on the margin. Here's a figure that I have at that time. That was in 2014. Oh no, let me jump to that. This was the foreign presence, the secondary JGB markets. So the secondary market, in fact, in the futures market, in the futures presence, the foreign presence in the futures market. So foreigners were investing very heavily in the futures market. So in terms of the futures market, we are pricing that's based certainly for a certain amount of stability in the bond market. That's going to certainly that's going to support interest rates in the long term. There's a lot of foreign presence. Well, the thing about foreign money is that it can just, when it runs, and if it's short-term debt, it runs and it's going to just flee. That money will just run out. That can run out the door at any time. Bond market presence is less. It's only about 20%. Remember, 8% share, but 20% of the trades in the bond market. So it's big relative to the size. So the foreign presence is important in the bond market. So in order to prop up all this debt, the government needs to have foreign money to come to some degree, even now. So that was, they say, 28% of the actual bond market, and more than half, and they affect the interest rate the government pays to issue new bonds. So the willingness of foreigners to invest in the market plays a role in keeping interest rates low. And a lot of that money, a certain percentage of that money is just quantitative easing in other countries. The Fed quantitative easing, and so it's a lot of play money running around. A lot of play money that's going on there. And let me go back to this table because this is the update. I update, this was as 2.5 years later, December 2016. And notice what's changed. Notice the change. Let's toggle that because that's worth, look at that increase in the BOJ. And I think that this is what's going on here. Look at the BOJ now. It's holding, the BOJ's holdings are almost the same as the banks and the insurance companies. That's 2.5 years. Look at the difference. Let's look at the difference. This is astonishing. 20% to 56%. 41% to 39%. And the debt has increased. So what's happening? Obviously, the BOJ is buying a lot of debt from the buyer is the BOJ and the seller is the buyer is the BOJ, and here these are the sellers. You can see how much they're selling. This is one of the things you can do to kind of figure this stuff out. You can see 19 is the banks and not the insurance companies because they're probably figuring that they're satisfied. The banks are selling their debt to it's just a shift from the banks to the. Well, what does that tell you? Does anybody think that if you're looking at this, what would any reasonable person? Do you have any thought on that?
I think it is the newest issued bond that are.
Right. That's right.
A majority of
Correct.
the newest issued bond.
They're just buying them up. Right. And they're maturing. These bonds are maturing, so it's just shrinking. Yeah. But effectively, they're buying it. Yeah. They're effectively buying it.
It becomes the only buyer.
They're the only buyer, right? There's almost no market. The market is almost dead in the bond market. Because who wants to buy But as I say, this is probably maturing. They must be buying some, if their percentages, unless it's just all long-term debt. Well, that might be. I mean, they're insurance companies, so that might be the structure of their debt is longer term of government holdings. The banks are just trying to get out, but it's also telling you, well, what happens when the interest rate increases? Well, this percentage is going to go up. They're going to keep on increasing that percentage. How bad?
Yeah, it's hard to renew the bond.
Well, I'm thinking, well, this because I had a conversation yesterday with someone. We were thinking about this because they say he's in the real estate business. You got to think about, well, what's that going to do to interest rates and all, and it's going to have an effect on real estate prices, and it's not positive. It won't be positive on real estate prices. But I'm thinking at some point the government's going to have to default. I think there's going to be some kind of default at some point.
Someday.
At some point. Well, when interest rates go up.
Oh, yeah.
If interest rates go to 2-3%, even 2 to 3%.
That's huge for.
It's going to be huge, and if the BOJ is holding it, then they're going to be they'll manage it. They're going to be managing it. The government will be able to manage it. So I think I'm guessing. My guess is that part of this is they realize this is good. This is a guess. I'd be interested in what people think about this and what But I'm looking at this and I'm thinking, well, how do you manage something like this? Well, if the government controls it, if the government controls the majority of the holdings, well, then they can manage it on the BOJ balance sheet. I mean, that's what. But basically, what you're doing, as I say, one of the things is you're basically by issuing all these bonds, you're basically monetizing and having the BOJ buy it. It's essentially creating money. I mean, because they're the buyer of the bonds, they're essentially creating. It's basically money creation. You're expanding the money supply. You're expanding the amount of money in circulation. So so you're monetizing. They're monetizing the debt. The fascinating thing, it hasn't been inflationary. It tells you how low the velocity of money is. The velocity of money must be real low, but if the velocity of money starts increasing, if the economy picks up and the velocity of money increases, you might get boom, you might get an inflation rate that suddenly jumps. You could get that. The thing is, it's been so long that we've had anything like this that nobody really knows what's going to happen. That's the thing, we don't know what's going to happen.
Do you believe that the Japanese government have the ability to lower the interest rate more?
Well, they seem, the Fed is clearly is clearly easing. The Fed's clearly tapering off. So QE is over in it's just a slow. They're going to slow release. As long as inflation doesn't rise, they can just do it. But the BOJ still isn't talking like they're going to, they're still talking like, it just kind of sounds like they with all this government debt, it's kind of in a hard position to do that. It's kind of in a hard position. But that is interesting because well, now you can talk about the tax cuts. I mean, personally, the tax cuts in the U.S. just don't seem, I don't get it. That just doesn't seem to make sense. But and I can't see that's going to increase government debt, and the government, I don't know, I don't get it. But as I say, I think they're going to be managing. They're going to be managing that. The question is, I don't know. I mean, does a central bank default on its debt? I mean, I've never heard of a major central bank has never done that. But what are they going to do? What are they going to do when suddenly they're bond holding, when they have to pay the interest, because they hold the bond, they're going to have to pay interest to the government, because they hold the government debt. I mean, the interest rate's real low, but it's going to blow out their balance sheet. They will monetize, that money will be out in the economy, it'll be monetized. I don't know. I'm not a macroeconomist. I'm just kind of, that part is, I'm just trying to, I'm an economist, I can think about it, but I'm not a macro person, so, it just seems like if you're talking about this kind of, and that's going to go up. That percentage is sure to rise in the next couple. It'll probably hit at least 50%. And you're talking about 500 trillion. 1 year of GDP that they're going to be holding of debt. It's going to be astonishing amount of debt they're going to be holding. So that's a very interesting. This is one of the current account balance, and I look at these figures. I updated this 2015. This confuses me because I've looked at the national accounts data. I don't see where the current account balance. And I saw the figures. That's the figures from the finance ministry, and something's not right there. I got to look at this more. If anybody, because I'm very familiar with the balance of payments. Not the current account, but the balance. And I thought that the current account was going almost negative. But the finance ministry figures are showing that. Something's funny about that, and as I say, because the reason why this is important, because once this gets negative, I think it should go negative. Once it gets negative, then the government begins to lose control over its bond market. The government's going to lose control over it. It's going to lose control over its ability to control interest rates. The government's been able to control interest rates and keep interest rates in this country low relative to the rest of the world because of the way they've done it. But if there's a negative current account balance, you're going to have to be borrowing money from abroad. And if you borrow money from abroad, you're not going to borrow on your terms, you're going to borrow on their terms if you have net borrowing. So that's, as I say, this is kind of, I saw that, I said, what? I don't know, I'm trying to make sense. I saw these figures last night, I'm putting it in. I know the other figures from the national accounts, because I've been, I teach that for the other class. I talk about the national, that seems different from these figures, so I don't get that. Let's see, we're just about out of time. I go over this. This just kind of shows the tax revenue sources, how it's kind of basically become less dependent on the income tax. That means it's a more regressive tax. It's less progressive tax. The average person is paying more taxes because it's just less. I think we'll start. Yeah, this. Let's see. Well, we'll have to quit. We'll have to quit there. Basically, the government was hoping. This is kind of like the wish, the aggressive growth, primary balance. It's not happening unless there's some real explosion. I mean, there could be an explosion of economic growth. So we'll close that there. Please just go over this. This tells you what happens with the use of the consumption tax, what the purpose is. It's basically to help prop up the Social Security system. It's just talking about this is the major demographic problem. I think we're going to start next week on the labor market. I'll probably take this and shift it to my discussion on that later. But this is it's certainly an important issue that affects government finance. So we'll close at that, and we'll be talking about the labor market next week. Thanks.